Good afternoon, everyone. My name is Raresh Pamphil, and I lead the Impact Agora. Thanks to the over 200 people who have signed up for our end of year event and to the speakers who have set aside time for this. Before we get into that and I introduce our moderator, I just wanted to say a few words about Impact Agora and also what we've done this year and what we're proud of. So Impact Agora is a community of organizations and a network of organizations involved in impact investing. Our members include accelerators, investor networks, advisors, fund managers, wealth managers, banks, family offices, and foundations. And we operate a deal sharing platform, which allows all these organizations to share opportunities that they vetted with each other, but also showcase funds that they have invested in or that they are fundraising in. Our members include all the organizations you'll be hearing from today, and also some of the ones featured on this slide, and some which have chosen not to be named. So we're proud that we're now at over 70 members who have logged in to share opportunities, find opportunities, and so on. In terms of this year for us, we're quite proud that we've, having launched in April, have come to over 30 opportunities that have been showcased on the platform, a fairly equal split between direct deals and funds. And we're also proud that we've facilitated 2 investments, which have a total of 8 million as a result of the introductions that we've made. In the last few months, we've become quite more systematic about how we facilitate introductions. So we're now at over 40 kind of intros that we've suggested to people based on shared interests, and over 20 calls that have happened with investors as a result of that to discuss specific opportunities. With that in mind, next year we hope to continue growing, and we're grateful as always for the support we've gotten from Barclays to fund the development and launch of this project, and also to Dario, who powers the underlying platform, but has also provided a lot of expertise and support throughout. And I'm really proud of the team that we have, which has helped us achieve all of this. So thanks to all of you who have been along the journey with us to get this far. And with that, on that note, I'll hand over to Jamie, who is going to moderate the session with our great speakers. Jamie Broderick is a director at the Impact Investing Institute, and he has a background in asset management and wealth management, and is also an investor himself. So Jamie, over to you, and look forward to hearing more.
Thank you, Raresh. Hi, everybody, and thanks for joining us this afternoon. And as Raresh mentioned, I'm a director at the Impact Investing Institute, but I need to mention that the Institute does not endorse individual commercial ventures or investment propositions, but on the other hand is very supportive of events and communications like this one that raise the profile of impact investing, especially in private markets, and that's our topic this afternoon. I should probably also disclose that I am active as a private investor, client of several of the organizations represented here today, which all seems very natural to me since I'm an impact investor, and these are some of the most interesting impact asset managers in the UK. So with those disclosures out of the way, let me just make a few opening observations. In my view, the richest area of impact investing is where investors bring additional capital to enterprises that are having a positive impact on society and the environment. And that's typically in the private markets. And that is why it is sometimes the hardest sector to get capital into, because the financial products are not generally regulated as retail products. They're not as familiar to the investing public or their advisors. And in the case of venture, can be at the risky end. There are exceptions, as I hope we'll see, but an extra effort is required to match capital with enterprise, which is why Impact Agora performs such an important role in matching investments with investors in areas of high impact. So Our format this afternoon will be 3 to 4 minutes with each of the investors that we have with us today. I've been on a lot of Zoom calls and nobody ever kept to 3 to 4 minutes, but we're gonna do our best this afternoon. That gives them enough time to present themselves and their organizations, and then leave you with key observations that you should keep in mind about them and the year that they've had in this most unusual year of 2020. Now, as they speak, feel free to put specific questions directed to them in the Q&A function, which they will try to answer as time permits. And then I'm going to try to pick up some of your more general questions to take to the entire group. So let me start with John Williams of Resonance. John?
Thanks, Jamie, and good afternoon, everybody. My name is John Williams. I'm the investment director and head of property funds here at Resonance. For those of you who don't know what Resonance do, we are a social impact investor in the UK. We are a social enterprise ourselves. We have 18 years track record of focusing exclusively on impact investment, and we do that through three themes. One is community, where we're backing community groups around the UK to build out local assets. The second is enterprise growth, where we're investing directly into small enterprises, social enterprises around the UK to allow them to grow. And the third is property, where we invest into real estate, residential property around the UK, and that's what I can focus on in this slot. So really, the model we have within property is very simple. We raise capital and then we acquire ordinary homes on ordinary streets around the UK, which we then refurbish and then lease across to quality housing providers around the UK, who then house and support vulnerable people. We do this through three themes. We focus on homelessness, or families or individuals at risk of being homeless. We also focus on learning disability, and we also focus on vulnerable women with these funds. We've been quite successful over the last 8 years. We've raised over 200 million. We've invested that now into over 1,000 properties around the UK, which are all occupied, which are all paying rental to the fund, and all of which are providing impact around the UK. This model really offers a safe and stable yield to investors, which is effectively underpinned by government income, because this is based on housing benefit, as well as the added value of this being asset backed with the upside for investors in sharing the equity that's built in the portfolio. When we look at our investors, we have a real range of investors, from high net worth individuals to charities to charitable foundations, right through to institutional investors and pension funds and family offices. And I think all investors are really important, because when we plan a new fund and it's quite innovative, we're looking for kind of catalytic investors. Once we have the track record, which we now have in a few of our funds, we're then looking to the institutional space and the pension funds to really grow these funds. If we look at 2020 and COVID, this year really saw an acceleration and a big demand for our funds. Typically, we would launch one of these funds every 12 to 18 months. And in 2020, in the last 6 months of this year, we're actually launching 4 funds. So it's been quite an intensive year, but it's really been born out of the demand for this type of intervention within the market. And I think looking forward to 2021, we really do see more capital flowing into this model, especially from institutions, I think, where they've looked at the equity market during COVID. They've maybe looked at commercial property or retail property and I think, well, actually, I'd much prefer to be, invested into ordinary homes and ordinary streets where there's an asset-backed yield, with the added benefit of real outcomes for people living in those properties.
That's great, John. A quick mention of you hit the headlines this week. Can you mention that?
Yeah, of course. We're really happy because last week, one of the 4 funds that I mentioned launched. It signed its first close, and we brought in a northern pension fund, a local government pension fund, into our model, which is a great win for the sector, I think. And I think there's more to come next year.
I think that's fiduciary investors saying, we believe in this, we can invest in this. I think that's a real achievement. So congratulations on that. Thank you. Let me move to Patrick Molyneux from Acceleris. Patrick, go ahead.
Hi, everyone, and thanks to Impact Agora for the invitation here. So I'm Patrick Molyneux, I'm Corporate Finance Director at Acceleris Capital. And Acceleris Capital are an early stage company focused merchant bank. So we work with innovative UK companies who need finance and support to really achieve their full potential. Our belief is that it's private companies that are the factory of innovation, and that by ensuring these companies are addressing identified thesis-driven opportunities that can make a real positive change, we will look to support them. Our sector focus includes health and well-being, so that's biotech, medtech, pharma, drug discovery, and also sustainability, which is where the relevant with Impact Agora comes in, energy transition, ag tech, for example. For companies, we provide regulated activity, so that includes direct investment via EIS equity, usually, fundraising, advice and support, and corporate finance advisory on an ongoing basis. We also offer non-regulated activities, so it's more than just capital. So we offer access to our global network of expertise and advisors. We can feed into early stage marketing, web design, accounting and bookkeeping, and also HR, legal and tax and regulatory support for these companies. We do find a lot of early stage companies do have gaps, and that's fine in their organization, and we're here to help them fill those. We advise companies from startup to exit, and we've been known to co-found companies as well. And we advise on multiple capital raises where required. Our approach is very much focused on the correct structure on each deal. And to that end, we do offer to our network of investors deal by deal opportunities. We believe this ensures that these companies have the right structure to grow in terms of the terms, and this will enable to open up further VC funding as these companies hopefully grow and become successful. We've placed around 200 million, probably just less than, into early stage businesses. And considering we are on the risky end of early stage investing, we're quite proud of our track record. So we've had a few exits, and we've lost roughly less than 10% of our invested capital across 20 years, which is we think is pretty good. Our investor group is high net worth individuals. It's family office investors. We also have a network of institutional funds who like our approach and help us with the follow-ons. So we co-invest with those, or we hand over the baton if the companies do grow. Private investors benefit from the ability to build their own bespoke portfolio of direct deals, benefit from EIS. And because we are on the company side, the investors benefit from no fees on their investment as well. And it enables them to access EIS straight away instead of waiting for a fund to deploy their investment. They also have direct access to management on each of their investments, which we like to offer. You know, they can ask questions directly, they can host calls with these managers, and they can feed in their experiences and expertise. And they also benefit from being part of this peer group of investors who share this belief in trying to do good. You know, capital investing and the small portion of direct EIS investing is a risky asset class. And if they can do a bit more in terms of positive impact, they do like that. So it's a peer group of investors with shared beliefs. Thankful to Impact Agora this year. So 2020, of course, has been rocky to say the least in this market, and definite ups and downs. And a prime example of that is a deal we've closed this year in Impact through Impact Agora. And it's a really cool deal. It's a platform company. It's ultra low cost energy. I won't bore you with it now, but Impact Agora really assisted us, considering we kicked off this fundraise in March 2020. So the timing wasn't ideal. But the positive, there's definitely a tailwind, and we're seeing it quite clearly of interest in this sector. And we did manage to successfully close the first tranche of that deal in August. So, you know, I started with a negative in terms of, you know, it was a bad time to open a fundraising, but wow, the positive of interest and Impact Agora assisting with, you know, driving attention to that deal, I think was a really positive result on that. So as a firm, we believe this tailwind is going to continue, and green finance is clearly going to continue to grow as an asset class. Being mainly EIS investors, you know, we do want to push the introduction of the knowledge intensive capital EIS. So this allows for the patience required for these early stage innovators. These are companies who are primarily cash burn, who are trying to solve big global problems. And knowledge intensive EIS gives them that bit longer and de-risks for investors that journey to becoming the global success that not only will provide good returns, but also good impactful returns.
I have to keep
and I think that's my 3 minutes.
I have to keep to the speed dating rules, but I did want to ask you a really quick question. Is there enough throughput in the SME space? I'm really interested in place-based investing. Can you construct place-based portfolios for clients? Like if I were in Manchester, could I build a Manchester SME portfolio?
Absolutely. Yeah, no, that's the whole ethos of what we try and do. And in terms of place-based, I think, you know, each area has its expertise, and I think you really need to look closely at what areas and what universities are doing in those sectors. But, you know, to be geographically based, there's innovation everywhere. So the deal I just mentioned was Northeast, and it's often ignored, but, you know, there's innovation everywhere. And if you want to be place-based and build a bespoke portfolio, indeed, an EIS helps that. That's
very interesting. Thanks for that, Patrick. Can we go to Emma Steele at Ascension Ventures?
Thanks, Jamie. Hi, everyone. So my name is Emma Steele. I'm an investment director at Ascension Ventures. And Ascension is a pre-seed investor in the UK. I think we're one of the most active pre-seed investors. Have done so mainly through tax efficient funds, so SEIS and EIS funds since 2015. And for the last 3 years, which is where I came in, we've been deploying an institutional fund called Fair by Design, at the time 10 million. Fair by Design is a fund that is designed to tackle the poverty premium in the UK, which is essentially the fact that low-income households pay more for goods and services just because they're low income, and hits about 20% of the population. Those premiums exist across various different sectors, such as energy, finance, insurance, consumer goods, transport, and the entire kind of fund thesis and sector verticals focus on investing in innovations that design out the poverty premiums in those relevant areas. So the fund is also part of a wider program called Fair by Design as a whole, that is attached to a campaign. The campaign itself is hosted by Barrett Cadbury. So it's very much a kind of a micro and macro way of really trying to tackle a big societal problem. And so far, I mean, I think we've done pretty well. So we're 14 portfolio businesses strong. We've managed to demonstrate both a kind of commercial track record with a fairly strong IRR and an impact track record with over 340,000 people now that we've helped that are affected by the poverty premium. And COVID has really shown this year that some of the business models that we invest in, such as business models affecting or improving financial resilience, for instance, have been really accelerated through COVID, and there's an element of kind of counter cyclicality to the fund because of that. So we've having kind of reaching the end of the deployment period early next year, we thought, well, instead of raising a new fund, we will actually leverage the existing track record of the fund, diversify the LP base, and try and kind of extend the existing fund, which Impact Agora have been kind of helping us on. You know, this really allows us to kind of leverage the existing kind of track record to be able to extend the deployment period, improve the fund economics, and try and kind of you know, operate more effectively and scale the impact within the context of COVID. We've now reached a point where we've raised 5 million and have actually found a more diverse LP base than before, which was mainly through, the fund was raised mainly through foundations. So it's an interesting case study where, you know, we've managed to basically leverage a good track record to find a more diversified LP base. So in a good position to start next year.
Emma, you mentioned, so poverty premium is high impact stuff. So but you also mentioned a pretty interesting IRR. So are you saying you're not making a return sacrifice by going into a high impact space like poverty premium?
We thought we were at the beginning when we started deploying. We thought there would be a high degree of kind of subsidization. However, we find that the types of business models we invest in are actually highly scalable, and the value proposition is very much aligned commercially and from an impact perspective. And I find the kind of common ground between the founders and the business models is that you tend to invest in business models where the value proposition sold to the customers really encompasses the mission and the social mission as part of the marketing and sales pitch, and the founders themselves are equally as motivated to build a big business than they are to scale big impact. So it's kind of those two things, I think, that are the kind of common ground in the types of business models and founders we invest in.
That's really fascinating. You need to get the word out there, because I think most people would make an assumption about poverty premium, high impact stuff, there goes my return. So I think it's really interesting to hear you describe it that way. Thank you very much. Can we go to Evita Zanuso of Big Society Capital?
Hi, thanks, Jamie. So thanks for having me. So I do work at Big Society Capital, but I guess I'm here to talk more about the recent announcement that we recently announced that we're partnering with Triodos to launch the Triodos BSC Social Impact Trust. So I know that I have a colleague, Dougie, that will be talking about social BSC. More specifically, sort of our balance sheet investments. So I guess, yeah, just to give you a bit of background about the Triodos BSC Social Impact Trust. So we think it's a really unique proposition that will open up access to private market investments, which, you know, Jamie, as you mentioned, you know, has that sort of extra additionality. But, you know, being very cognizant of the fact that a lot of investors do struggle to access private market investments. So the idea of this really is to open up access to a wider range of investors with a publicly listed vehicle. So we are sort of targeting 100 million trusts with the aim to scale this over time. Now, you know, why are we doing this? So Big Society Capital, as you guys, some of you may know, was established back in 2012 to promote really the development of social impact investing market in the UK. Since then, you know, the sort of high impact market in the UK has grown quite significantly, which we value to be sort of over 5 billion. Now, we believe that by managing investors' funds as well as BSC's own capital, ultimately will bring more investment into the social impact market. So very much in line with Big Society Capital's mission. And we want to raise awareness of interest of social impact investing, and the launch of this investment trust really is a key step in sort of achieving that. So I should say that the investment trust will have a different mandate to Big Society Capital's own investment mandate. The trust's mandate really is looking to invest into, I guess, funds that are probably more proven on both financial return and also on impact. So less playing that sort of catalytic role, but essentially the trust will really invest into funds and co-investments in 3 areas. First being high impact housing, so housing that tackles homelessness or housing needs of people that are survivors of domestic abuse. Second bucket is debt for social enterprises. So, for example, supporting people with learning disabilities, health and social care. And then the third bucket is social outcomes contracts. So, you know, lots of different sort of themes there, but really an example may be delivering evidence-based support for children at the edge of care. And, you know, as I mentioned, you know, that the reasons for wanting to do this is very much number one, you know, trying to lower the barriers of access from an investor perspective. You know, we really designed this in many ways with individual investors in mind, those that really struggle with limited partnership type structures, which I know that, that's why Impact Agora, partly sort of exists, is to be able to help access these types of funds. And then I think secondly, that's really important is, we really want to lead by example. We would love to see more of these types of kind of high impact investment products that, freely able to sort of be accessible to a wide range of investors, perhaps other investment trusts in this area. And then, thirdly, very much in line really with Big Society Capital's mission, there's many really impact-driven fund managers and organizations that develop really innovative solutions to tackle social issues in the UK. Many of you actually are here, and we've identified, some models that we think they're at the point where they really require significant amounts of capital to scale. So it's really about trying to bring more money into those types of opportunities.
Thank you. And since you and I are both on this, we should probably,
yes.
I'm a director of the trust.
Yes, sorry, I meant to mention that. Yes, we have a fantastic board, because of the
Amazing
investment
board.
Trust. We have a fantastic board, and it's great to have Jamie, obviously, be willing to be involved and share his expertise as a board member. So.
Just a quick question, because we need to keep moving, but John Williams of Resonance mentioned government-sourced income as a different kind of economic exposure from other forms of, in his case, real estate. Is that also true of the trust?
Yeah, I mean, a good proportion of the trust has government-related revenues, absolutely, and particularly, as I mentioned, social outcomes contracts, and a big chunk of the housing allocation, and also some of the debt for social enterprises. And I guess from the kind of investor conversations that we've had, part of the attraction, obviously, as well as the impact, is the sort of investment thesis for this trust, which is that it's lowly correlated to what investors actually hold, and part of that is that sort of government source revenue.
Yeah, great. Thank you, Evita. Can we go to Whitni Thomas at Triodos?
Yes, sorry, I'm just trying to unmute. Yes, so my name's Whitni, and I work for Triodos Bank. For those of you who don't know us, we are a 100% dedicated social and environmental bank. So what that means is we take money in from depositors, and then we only lend that money or invest that money to social and environmental organizations. And we also tell people what we do with their money, so we are also 100% transparent. Alongside the bank, we have a corporate finance team, which is the team that I'm part of. And what we do is that we advise social businesses, charities, and environmental organizations who are looking to raise capital directly from investors. We structure the investments after having spent quite a long time working with those organizations. And if we deem that they're going to be appropriate for retail, we will promote them on our own crowdfunding platform. We also structure investment opportunities for professional investors only, but some of the investments will also just bring in a mix of both investor types. So we provide quite a hands-on, I guess, advisory service, if you like, spending quite a lot of time working with organizations. We've raised over £175 million of risk capital for these direct impact investments. And 60% of that has come from individual investors. So that's a mix of high net worth, sophisticated, and retail. And 40% has come from institutional investors. So quite often we have institutions that are investing alongside retail. And these institutions would typically be ethical social funds, private banks, wealth managers, charitable trusts, foundations, and family offices. So I just wanted to spend a minute telling you about a couple of investments that we've worked on this year. The first is for a national charity called Theratrust. They've got a 22-year track record of supporting individuals with a learning disability, and they support over 3,200 individuals. These are people with really high needs who need very specialized care and need tailored and bespoke accommodation. The charity has about £75 million turnover, and over 90% of the income is secured through local authority contracts. So we've worked with Thera 3 times now to help them raise capital, and most recently this summer. And what they do with the investment that they raise is they buy residential property so that they can provide homes for some of their beneficiaries. So as John mentioned, it's the same idea of, you know, an ordinary house and an ordinary street, so that these individuals can live the kind of life that for you and me, you know, would be considered normal, but for them is really life-changing, especially if they've come from a group setting. And the somewhat preempting the question that I know Jamie's going to ask me, but the rent that they agree with the local authority ensures that they can cover their core costs and also includes their financing costs. The second organization I wanted to tell you about is Nottinghamshire Ymca. They're also a very long established charity. They've actually been around for 150 years. And their core operations are supporting people at risk of homelessness through hostels and also looking after children in small group settings. And like Thera, the bulk of their contracted income, over 75%, comes from local authorities. But in addition to accommodation and these support services, they also operate children's clubs, wraparound care, fitness programs, and they are really dedicated, and their vision is really about trying to transform the area in which they work. And so they've been working on a community and activity village in Newark-on-Trent, which is really core to the regeneration of the area, working closely with the local authority. And with a variety of partners, they're going to provide educational, health, leisure, and community services to the town and the surrounding area. And so what we've done is we've helped to put together a funding package for them, and that includes some senior bank debt and also a charity bond to complement the capital grants and the fundraising that they've already secured. So just a few kind of key takeaways from me from what we've learned this year. The first is that those charities that provide services to people and to individuals with the highest need have actually been quite well supported by local authorities through the pandemic. And so that's really been, I think, quite pleasing to see. And we know that it's been much, much harder for those organizations that rely on trading income or individual giving or fundraising. The second point is that once we got past the initial first couple of months of the crisis, you know, think kind of end of March, April, May, we saw appetite from investors really remain strong. And we haven't struggled at all to close any of the 4 deals we've done in the second half of this year. And we were actually really surprised by how robust investor demand has been. And finally, we just know that from talking to our investors, whether it be retail investors or institutional investors alike, that they quite like these direct impact investments because it just really enables them to understand and to see and to kind of touch and feel, you know, the impact of the finance that they're providing.
Thanks, Whitney. And you did anticipate my question, but it was really, I'm just fascinated that people, I think for a lot of people, they're not used to having charities issue debt instruments. And what you've described, I think, makes it quite clear that there's an income stream that's backing that makes it, you know, accessible from a credit standpoint. You've seen the cash flows that are backing the instrument. And I think that's a dynamic that I think explains why charities issuing bonds makes sense. So that's
yeah, I mean, it's just like with any investment, it's the underlying operating model, you know, that just determines the adequate type of capital. But really, as I said, we've just been really amazed at how resilient the organizations have been, but then also just how robust investor appetite, you know, has remained.
Yeah, thanks for that, Whitney. Can we go to Zoe Peden from Ananda Impact Ventures?
Thanks, Jamie. So yes, I'm Zoe. I work for Ananda Impact Ventures. We make equity investments into B2B software companies across the UK and Europe as well, now that we have to split UK and Europe up when we speak. But all the impact is within UK and Europe, and we have a preference for late seed, Series A. Initial ticket size tends to be 1 to 3 million, and we can invest up to 7.5 million in the companies that do well. We've got 27 investments across the portfolio, and that's across 3 funds over the last 10 years. So we've been doing this for quite some time now. In terms of the sectors, we invest in digital health. We've got about 1/3 of the portfolio in that area, sustainability tech, lifelong learning, aging tech, and software that encourages equality. I particularly like that last one. And what makes us a little bit different, it's not unique, but we're all founders and operators. We've all built our own tech startups. So we like to, you know, we've got that lived experience as entrepreneurs, and it's very important that we invest at eye level. We do keep a close eye on the investments that we do. To give you an example of some of the companies in our portfolio, we've got one called IESO Digital Health. So now working at scale, I think it's the UK's largest mental health scale-up startup that provides online CBT across the NHS now. We've got Open Bionics. If you do a quick search on them, you'll find some amazing videos providing 3D printed bionic prosthetic arms. Just incredible, absolutely amazing. And also Third Space Learning, providing affordable online maths tutoring to disadvantaged pupils in schools. So it is quite a broad remit in terms of investment areas. And where we are on the spectrum of impact, since that's what today is quite a lot about, very similar to where Emma is, in that impact is baked in to the business model. So the more you sell, the more impact you have. And we need all our companies to have a theory of change, and with key business driver stroke impact KPIs that we keep a very close eye on. And to put it into context about what kind of 2020 we've had, well, I think the first few months of the pandemic was making sure all the companies, and I mean all, that were doing well and on a good momentum before it struck, were then solidified for the next 12 to 18 months. So our lawyers, I think, were rubbing their hands at the amount of new deals that had to go through to make sure that happened. And on top of that, we also, an example of that actually is Third Space Learning, the online maths tutoring one that I was just telling you about. So they successfully secured, alongside 3 other mainstream investors and us, 4.3 million funding extension. And this is to help them support even more primary teachers in the UK. What was really interesting about them is during the pandemic, they doubled in revenue. So this was a perfect time to, you know, to move on to that and extend their funding. And the pandemic opened up not just, you know, UK primary schools. They always had this plan to move to secondary schools. It opened up international markets for them. So they've got a partnership with NetDragon in China, and they've also got a partnership with Edmodo in the US. So you can see the kind of things that opened up for that company. Really, really good to see, because Tom, the CEO, has been cracking at it now, I think, for 7 years. So this is like resilience at its core. And we also had an exit with Arbor Education as well. The Key Group acquired them. So Arbor Education is management information systems for schools, primary and secondary. So they were the fastest growing MIS system basically in the UK. So that's why they got acquired. So to see over the last 2 years, see them rocket and win, you know, winning over 50% of all the tenders that were out there for MIS systems, Arbor was winning. So really great to see that happening in EdTech. And then I also co-led an investment into a health tech company called Dr. Doctor alongside 24 Haymarket. So not an impact investor, but a mainstream investor, making secondary healthcare outpatient systems more efficient. So did a bit of everything. So an unusual first half of the year, but the second half was much more positive. And I think, like everyone else is saying, things really got underway. So yeah, an interesting year.
Thanks, Zoe. And I love the strap line, let's build stuff that matters. I think that's a really clear description of what it is we do. I quickly ask you, because we are short on time, but can I ask you, so what did you learn by going from being a founder to being a manager?
Yeah, I'm moving from one side to the other. Things move a lot slower this end, and you know, you're always running at absolutely crazy speed on the other side. And I learned that you have to understand why it's slower, because you're managing someone else's money.
Yeah.
You know, the risk is different. So I've learned that, and I've learned to be a bit more patient. Still fairly impatient, and to slow down a little and be more careful, and look at risk differently.
Yeah.
I think that's the biggest thing that I've learned personally.
Interesting change in perspective.
Mm.
Can we go to Ilian Iliev from EMV Capital?
Thank you, Jamie. So good to see you all and meet some of you for the first time. So I'm wearing two hats. I know most of you as part of EMV Capital, which I set up a few years ago as an investor in energy and industrial high tech with a slant towards energy efficiency and climate change friendly technologies. But over the summer, there was a transformational event whereby EMV Capital was acquired by AIM-listed Net Scientific, who are a healthcare investor with a similar investment strategy to that. And I'm now Group CEO of Net Scientific and continuing with my role at EMV Capital. So I'll talk about the combined entity, but a lot of the strategy we pursued with EMV Capital is retained within the group. So as a group, we are a transatlantic investor in companies broadly in the healthcare and sustainability space. We have investments in about 15 companies in the US, UK, and Israel. And we invest across the full life cycle from late seed through to exit, and in one case, even in a listed company on NASDAQ. In terms of the investment approach that I've been building up with EMV, that's also consistent with Net Scientific, is that we're a hands-on investor in these businesses. We have a bit of a specialism in investing I don't want to say hard companies, but often hardware companies that tend to be hard. But basically doing a bit of alchemy and taking what are capex heavy models, business models, and combining private finance with grant, but also corporate JDA funding to make those companies fundable. Often a brute forcing a capex heavy company is just not interesting for private investors, and we look for ways in which they can become more interesting and more investable. Now, in terms of the model we're taking forward, basically we're funding companies from a mixture of sources. We combine balance sheet from Net Scientific with the syndication capabilities of EMV Capital. Within that, we have a growing EIS investment practice, a family office practice working with family offices in the UK and internationally, as well as a corporate practice where we attract both corporate VCs and corporate JDAs. And it's the combination of these different sources that I think is quite interesting for all of us and for the industry, making companies that are really interesting, really exciting, but not fundable, let's say, from one single pure source of funding, because it's too expensive, too complicated. You don't have the international reach, but the combination of these sources makes these businesses scalable. A second pillar, additional pillar of our work is the cross-Atlantic bridges. And here, as far as UK companies are concerned, we believe that UK companies in general should internationalize faster and should internationalize with the right partners. This can be with corporate partnerships or with investor partners across the pond. But equally, having a more international approach enables companies to get to other markets faster. One example is Glycotest, which is a company developing a liver disease diagnostic. We have a co-investment there with Fosun Pharma out of China because the biggest market for liver disease is in China. But on the back of that investment, we're able to develop and commercialize tests for the US and beyond. Now, when it comes to the sustainability focus, a lot of our investments there have been around robotics, smart buildings, and kind of not the full frontal approach, should we say, that let's invest in a new wind turbine. And our thinking there has been that a lot of the gains that you can have in terms of improving the climate impact of these technologies are in the boring old areas, increasing the industrial efficiency, going through the housing stock. And through Qbot, we have exposure to improving the insulation of housing stock. Through Point Grab in Israel, we have exposure to improving the efficiency of commercial offices. So there's different ways of getting to the climate impact that is in addition to renewables. So there's there's a hybrid approach, shall we say, in terms of the sectors that we focus. Sometimes we find the most interesting innovation is on the overlaps between sectors. A good example is SageTech Medical, in whom we closed the scale-up round recently. And in that case, we have a company that has developed a platform for the capture and recycling of anesthetic gases. Now, when I first came across this, I said, well, this is a problem. I didn't quite realize that this is an issue, but it turns out that anesthetic gases are part of the Montreal Protocol on HFAs, hugely damaging for the environment, for the ozone layer, and also for 8 times the greenhouse gas emissions of CO2. But of course, you need to operate people, and we're not in the Middle Ages, so you need to put them to sleep before you operate on them. So they're kind of necessary. Well, this company has found a way of capturing, storing, and potentially recycling this technology. Now, here is an overlap and a hybrid between healthcare and climate change friendly technologies. But in addition to that, what we found with this company during COVID is that their technology actually also helps to make operating theaters and ICUs more flexible. Because at the moment with operating theaters, you need to have expensive ventilation installed and so on and so forth. And this approach enables greater flexibility. So, and this brings me to the COVID point. What did we do when COVID hit? Well, the first time, of course, was, problem. So the first thing is we looked at all of our portfolio companies. We stopped all new investment. We focused on the portfolio companies. Who has what problems? Who has how much runway? Let's work with them to provide them additional runway. But then the next question was, okay, well, this is a major opportunity in a positive sense. Whenever you have such a major shock to the system, technologies that might have been on the verge of adoption tend to be adopted. So I explained to you in the context of SageTech what we saw. Well, actually,
Ilian, we're gonna. I mean, unfortunately, you've passed your speed date quota. So, and I also want to point out that I think a couple of my panelists here have to depart. So if they disappear from your screen, they're going on to their next Zoom. But Ilian, could you kind of wrap it up?
Well,
just, I mean, it's interesting. The COVID story. We'd love to hear the COVID story, but then
sure. I'll give you 2 other examples in our portfolio, and I'll wrap it up with that, because I think the portfolio companies, I forget which philosopher says is you are what you do, so I'll stick to that. In the case of PointGrab, what we looked at is they were focused on improving the smart office. Well, until now, the problem was how you can keep more people inside the office in a way without them damaging their productivity. Overnight, the problem became, well, how can you prove that you've minimized the number of people in the office so that they can operate in a COVID safe manner. So they flipped their software, and actually you can use the AI software to do that. In the case of PDS, which is a cancer therapeutics company, it turned out that their approach, it's a NASDAQ listed company, it turned out their approach actually, as we found with the Pfizer vaccine, actually you can use that to develop a vaccine. So there we have a partnership in Brazil developing a vaccine, a COVID vaccine, and just more broadly around the corona family of infections. And I guess my final point on that is that, look, we are in the venture capital space. Each of these crises that are massively disruptive for the economy, it is our role in society to identify the opportunities and act on them rapidly and help our companies capture those opportunities. So from our perspective, that has been the theme of the summer.
That's great, Ilian. Thank you very much. Let's go to John Coker at Adaventures.
Hi, so I'm John Coker at Adaventures. We're a early stage UK focused impact venture fund. We're a relatively new fund. We came together as a team right at the end of 2018, started fundraising in 2019 and closed our first funds and investments this year. We are built around 3 founding principles. So the first is shared value and a belief that the most successful companies of the next 20 years will be built to solve a clear social or environmental problem in our economy. The second is a focus on consumer technology. So that's the founding team's experience as investors. And we believe there's a huge opportunity to use technology to shift our consumption patterns to be more sustainable and to foster health and inequality in the way that we build our supply chains. And the third principle is founder development. And our experience tells us that the single biggest driver of success in a venture-backed business is a founder's ability to develop their leadership as their company scales from 10 people to 500 people. And we wanted to reimagine what a venture fund that was set up with that belief would look like from the perspective of understanding people. And actually all of those kind of three principles come together in that we back mission-led founders building consumer technology companies. Specifically, we're focused on three themes. We focus on consumer healthcare, so backing the shift from a reactive treatment-driven system to a more proactive and preventative system, thereby improving health outcomes and reducing cost, hence the shared value. We focus on non-discretionary products and using technology, so non-discretionary products, things like nutrition and mobility, and using technology to make them more affordable and accessible to everybody, thereby increasing the addressable market and also providing people with products who currently struggle to access them at an affordable price point. Our first investment was in a home and contents insurance business doing exactly that. So using data science and software to reduce the loss ratios in home and contents insurance and bring the price point down, as well as building transparency and accessibility to underserved groups. And then our third theme of interest is sustainable consumption. And there we're very, very focused on efficiency plays. So specifically looking at companies that are using technology to build a resource-light, more circular consumption model. And our second investment is a company that is building a supply chain software platform for consumer businesses that allows them to access ethically sourced and sustainable packaging at scale in an affordable way. We're a really early stage investor, so typically companies that we're backing have got revenues of somewhere between 10,000 and 100,000 pounds a month. So we're typically the first institutional investor, but normally they'll have taken an angel round before us. So as I said, we made two investments. We have, so we raised our first funds this year. We have 29 million pounds under management at the moment. We are working towards our final close, which should be 60 million in Q1. I guess so we've not formally announced the fund and the launch yet, so not talking too openly about our investor base. But I will mention Big Society Capital, as they were one of our first investors and have been incredibly supportive over the last year. And another reason for mentioning them is that the original introduction to Big Society came through Raresh at Impact Agora. So it's a good kind of story there amongst the group. I guess the rest of our investors are a very interesting mix of large institutions and individuals from both the impact community and the technology community. So we have 18 technology entrepreneurs invested in the fund. 11 of them are actually founders of companies that we backed in our previous venture careers. And I guess kind of wrapping it up in terms of the effect on COVID or how we've navigated COVID, I guess for a new fund launching at the moment, it was a relatively daunting prospect. Back in March, we went into lockdown with having made no investments and no funds under management. Fortunately, we now have made investments and we have 29 million under management, but it was definitely a challenging period for us. We had an absolutely amazing response from our investors going through that. I think everyone realized that there was an extraordinary shift towards a more digitally focused economy within healthcare. There was a huge opportunity within sustainability and within kind of affordable discretionary products. Well, those are the resilient sectors in our economy, and they're also incredibly important areas to focus on. That's probably, that's us. So.
That's great, John. I wanted to just quickly ask you, so you're in an interesting space. It's kind of late seed, early Series A. Is it less crowded there?
I think it's definitely the Series A. Well, the definitions are hard, but Series A has become the round sizes have gone up dramatically, and there are a lot more players. I think when we think about our founder focus, we definitely find that kind of engaging with those founders early and being able to build relationships with them early and getting to the point where we can understand them and their development capacity early helps us, and it feels less crowded.
Yeah. Okay. Thanks, John. Now, Raresh, I think you warned your audience that we may well run past 60 minutes, and I think nobody really expected me to interview 10 different ventures in under 60 minutes, but I think we are going to run a little bit over. So just to give a bit of warning. Also encourage people, if you have a question, go ahead and stick it in the Q&A. It could be targeted at one of the people on the screen or more general, but feel free to do that. We'll pick up some questions at the end. But let's go to Dougie Sloan at Big Society Capital.
Great, thanks, Jamie. So Big Society Capital was founded in 2012 with a mission to grow the market for impact investing in the UK. And to do that, we bring together people and ideas and capital for impact. Specifically, we invest our 625 million of proprietary capital in funds targeting a positive social impact. And we're a multi-asset investor across asset classes, including housing, debt for social organizations, social outcomes contracts, renewables investments. But specifically today, I'm going to talk about our venture investing program. And venture capital is about 15% of our portfolio to date by value. We're currently in 10 live venture funds. And what gets us excited about venture, the reason we're kind of interested in venture investing, is that we see the impact potential of tech-enabled startups as being really powerful in the right circumstances, with the right intent, and with an aligned business model behind them. I guess specifically in that market in 2012, in 2020, we were on a little bit from 8 years ago. In 2020, we've seen the VC ecosystem become more aware of the impact it's having currently. That's particularly become top of mind in light of the multiple crises this year, really looking at COVID, but also some of the stuff following the killing of George Floyd, and also some of the awareness around the climate crisis as well. And so we're seeing VC become more aware of the impact it is having, and becoming aware of the impact it could have. It was more intentional about seeking that impact. We're also seeing the VC ecosystem waking up to impact being a driver of value, where it can reinforce strong commercial and investment outcomes in the right circumstances. And as a result, we're seeing far more managers interested in impact, and far more impact deals being done in the ecosystem more broadly. And in that context, we see our role as helping to develop an ecosystem that can scale innovative ways of tackling social problems, and also looking to shape and accelerate this ongoing shift towards impact that we're seeing by making sort of targeted interventions in that system. And to give an illustration of what that can look like in practice, there are 4 venture funds we've made investments into this year, and I'll just say a word on each of those. The first one, I'm doing them chronologically. The first one was Connect Ventures' third fund, which is a seed stage fund, pan-European, based out of London. They support product-led and purpose-led founders of software companies. And impact isn't everything that they do, but it's a significant subset of their investments that have intentional and positive impact. And we're excited with Connect by the opportunity to demonstrate what's possible to other top-tier venture funds in the mainstream who might be interested in impact. The second fund is Bethel Green Ventures, who run a Tech for Good accelerator program and an early stage venture fund alongside it. We've worked with them for some years and continued our relationship with them this year. And particularly with BGV and with our recent investment, we're excited by what they can do with this further capital to support impact companies right at the earliest stages of their investment and development journeys. The third fund is actually Ymca Ventures, who we heard from just now from John, who invest at that pre-A and Series A stage into sustainable consumer technology companies, with that focus on healthcare, inclusive products and services, and sustainable supply chains that John mentioned just now. And I think what we're really excited about here is this shared value element of the thesis, and how impact can drive return in those sectors, and the rigorous impact practice that Ymca are building around that, I think is really exciting, can be pretty pioneering. And the fourth and final fund I'll mention is Adaventures, who invest at pre-seed and seed stage into diverse founding teams addressing problems experienced by underserved groups. And we're excited by the passion that Ada bring to tackling the issues around diversity and inclusion that exist within the venture ecosystem, that are really stark within the ecosystem, in fact, and the way that they can deliver strong impact while doing so. So that gives you an illustration of the sorts of investments we've made this year, and we'll keep making investments along similar theses in years to come. And we look forward to deepening our relationship with others in the Impact Agora ecosystem as we do so.
Fantastic, Dougie. Thanks very much. I mean, it's been so interesting throughout this conversation at the number of intersections. So, I mean, it's clear that we're talking about an ecosystem and a collaborative ecosystem and intersecting ecosystem. And I think Big Society Capital is kind of the epitome of that. But I mean, it's great to see all this under the Impact Agora umbrella. Raresh, I think it'd be interesting if we could hear from Toniic, because I think there's a partnership organization. Can you roll the tape from Dario Parziale?
Yes, coming right through.
Good afternoon, everyone. My name is Dario Parziale, and I am the Director of Investment Research at Toniic. Toniic is a global community of impact investors, and we serve primarily asset owners such as high net worth individuals, family offices, and foundations. And we focus on creating a global community of practice, providing access to investment opportunities, as well as education. We are very excited to be collaborating with Impact Agora, as we believe it is a very much needed initiative in the impact investment ecosystem. We believe there is a strong need for collaboration among investor networks so that more impact deals can get funded, but also the resources spent on due diligence can be leveraged across multiple investors. We've been following the Impact Agora from its early days since it was incubated by Barclays, and we've been big fans of all the work that has been that has gone on, but also about the Impact Agora team. So we are very excited to open up or providing access to the platform to some of our European investors primarily. We also believe that it will, for our investors, it will provide access to more institutional deal flow. We exchange network deal flow among our members, but as most of our investors are individuals or family offices, smaller family offices, typically they move very fast when it comes to due diligence and execution. So by collaborating with other institutions, we believe it can offer a variety of deal flow beyond what we typically already provide to our members. So we believe it will be highly complementary. And at the same time, we believe that also some of the deals that are invested by Toniic members could be exchanged with other Impact Agora partners, and by virtue of that, increase the chances of success for all these companies and funds. So we look forward to this collaboration and exchange, and thank you all for your time. I'm sorry I couldn't join your event in person. The time zone didn't quite work, but hopefully we'll connect with many of you through the Impact Agora platform. Thank you.
And thank you to Dario Parziale, even though he can't hear me. I wanted to ask one general question to the group. I'll just throw out the question to the group, and anybody's got an answer for me, I sure would love to hear it before we close. So my question is, and short answers are always welcome, but what is the private market impact ecosystem in the UK missing to get more capital? What is it about the ecosystem that is missing still? Is it, is it structures? Is it investment structures? Is it tax relief? Is it awareness? Is there a regulatory thing? Is it financial advisors? Go ahead and unmute. And Whitni, you look like you got something to say.
I mean, my first thought on that, and this is particularly the case for direct investments, is just a, secondary market. So for most impact investors who, it's typical when you buy a fund, but who are buying direct investments, these are buy to hold investments. And so, they might suit some people, but they won't suit everyone. And so having some kind of functioning, marketplace, even if it's on a bulletin board system or something like that, would definitely help to unlock further capital.
Okay, thanks for that. Any other views?
I think we're a bit short on impact-focused PE to buy out some early-stage businesses. There are some, but I think we're a bit short. And I also think the amount of kind of post-seed, pre-Series A kind of patient capital VCs could be padded out a tad. As well. Back to my patient's point earlier. That's my quick answer.
Thanks, Patrick. Ilian, you have something to say?
Yeah, I mean, I think what we're seeing is there is no shortage of capital to deploy. I think what's missing is enough realistically ambitious, shall we say, companies. And what I mean by that is not crazy ambitions, but aggressive, high growth, ambitious models with the ability to execute. I think this is a really big gap in the market from the deal flow side.
Okay. Thanks. John, do you have a view? Does residents must have a view about something that's missing? I'm pretty sure.
Yeah, I think it's awareness, and I think there's a big misperception in the market that social impact investment means a haircut on returns and it means risky investments, and it's not the case. I think, you know, the group here of managers are structuring sensible structures that deliver risk-adjusted returns, and in some cases are actually better risk-adjusted returns than commercial because of the structure and focus on impact.
Okay, Dougie?
Yeah, I think particularly looking at the venture ecosystem, we've come a long way. It's a vibrant and fast maturing ecosystem, but what we still don't have concrete evidence of is delivering exits at a high value. So there's plenty of companies on a path to that. And I think in the next few years, we'll start to see some of those exits being realized. And the point I'd make that's linked to that is rigorous but proportionate impact practice that shows that these companies that deliver strong exits are also delivering strong impact. And I think we're going in the right direction on that, but standardized high quality impact data that can underpin that outcome would also be a welcome addition, I think.
Thanks, Dougie. And Zoe, are you happy just to build stuff that matters, or do you think there's something additional needed?
I think everyone's touched on a little bit. It has improved so much over the last 10 years. It's very hard to nitpick because when I started out in it 10 years ago, there was hardly anything. So it really has come from nothing, especially the venture world, to being quite accepted. I mean, all our co-investors are mainstream VC investors, but there's a tiny little bit still on reputation. Like you were saying, John, you know, they don't think they give enough returns. Why do they want to partner with Ananda? You know, that kind of thing. So we still have a little bit on the brand and our image to do. And I'd like to see more Series B. So you've been talking about late seed Series A, which is where we are. I actually want to see more in the Series B. So
okay, that's great. Thanks very much. Listen, it's been such a pleasure working with you. Really well done, keeping to time and giving a real good portrait, you know, a real diverse portrait of what private market investing is doing in the impact space in the UK. So I really appreciate it. Thank you very much. I'd like to pass the mic over to Damian Payatakis from Barclays for a final word.
Thank you. Just to close out, I did want to share very briefly some gratitude from me and from Barclays and from Dario. First, obviously, to Jamie for facilitating without endorsing. And thank you to the panelists as ever for sharing their thoughts and a little bit of an insight into their living rooms. Obviously, we've gotten all a little bit better about what we have behind us these days. To shamelessly steal a little bit of a format that our UK head of the private bank uses oftentimes, he always says, every day is a school day at the end of these sessions. So what did I learn about the industry today? Some very quick thoughts. Amidst the pandemic, not only can you launch funds, but 4 funds in 6 months, probably a record unto itself. With apologies to Dickens, it was the bad of times, it was the wow of times. Even those in the industry can be surprised about the financial returns from solving systemic problems, even as difficult as the poverty premium. The industry now needs money to scale, not money to start. Good organizations are resilient at any time. It's important to invest at eye level and to keep an eye on your investments. The new alchemy may be taking CapEx heavy businesses and connecting them with the right capital and connections. It's always possible to meet new people in this sector, and the VC industry is more aware of its impact and the impact it could have and changing accordingly. There was a small competition for the panelists on timekeeping for those closest to 4 minutes without going over. I won't shame everybody else, but John from Resonance, congratulations on 3 minutes and 46 seconds. More importantly, though, a second thank you really, most importantly, to all those who've joined Impact Agora. I know in some respects, many of you probably will have been skeptical about Barclays getting involved in this space. You know, large firms like ours tend to be more visible, but possibly and negatively in our role in the financial system. And I think we've always thought that that there's a bigger role to play, and we're only one part of the system realistically. You know, if I think about all the intermediaries that we see on this slide and all of those that are involved, it is arguably more critical to the success than those like us. And I think when we started the discussions with Dario a couple of years ago, we kept on hearing about more and more people wanting to get involved in this space. But the challenges of fragmentation, the things that we're all familiar with, and the capital and the struggles and the need for integrity as more people are coming in came out. And so we wanted to build this community and this pipeline for ourselves, but also solve it for more than just ourselves. And I will say, after quite a long time internally and the efforts and the conversations with Dario, we launched Impact Agora only back in April, which I'm sure, like many of you, feels like several years ago, as it were. And it's still in an early state, quite honestly. And I think we couldn't in some ways be more appreciative or humbled by the response that we've gotten from those of you on the line who've joined us today, who've joined the platform, who are just interested in hearing what's going on. I think it speaks really to the power of the industry, of collaboration and community. And I think I'm quite honestly very confident that from the companies that we and you really are involved in, we will see some of the companies and the entrepreneurs solving our biggest social and environmental problems. There is no doubt in my mind that they will come from the organizations that you guys have helped to fund and that we have helped to drive capital to. And that actually, for me, has the most sense of gratitude in many respects. So thank you very much for joining us. I do hope if you haven't been in touch or aren't members that you do consider it, or please tell somebody else. We are looking at scaling up next year and going forward, and we do need more members. The power of this community is based upon the community that it stands. And I think if nothing else today and in general, you see the quality of the members that we have and the power that that generates. So thank you to all of those who are involved, without a doubt, to Raresh, to Ash, to Matt, to Stefano, who behind the scenes are really driving this forward. And finally, most importantly, a very humble thank you to all of you for being involved in the sector. It's a real pleasure on a personal basis every time I have a chance to interact. And I find a lot of sense of energy that comes from it versus the day-to-day joys that we do tend to have in the larger organizations. So with that, I will wish you and yours a very safe, healthy, and prosperous 2021, and looking forward to being in touch with you all in the future.
Thanks, Damien.